So in this lecture, I'm just going to start with the corporation and what are the features and characteristics of the corporation. So what is the form of organizations that I will be going to explain, the characteristics of the corporation, disadvantage of the corporation, along with the advantages that will be covered in the characteristics. Organizing a corporation, how we can organize and how we can incorporate, I mean how we can start it. So organization's cost, it means the setup cost, then management of the corporation, what are the board of directors, what is CEO, CFO and COO, right? And what are the different rights of the shareholders that I will be going to explain in this short lecture. So before starting the corporation meaning, I just would like to explain the three forms of organization: proprietorship, partnership and corporation. So as we can see that it is a business entity, right? The proprietorship is the business entity. Yes, this is a business entity. Partnership is a business. Yes, and corporation is also a business entity. And if we talk about the legal entity, yes, the proprietorship is also a legal entity. No, it's not a separate legal entity. Means the partner, proprietorship, the person who is running the business will be responsible for all the debts of the company. Means is not different from the business, will be considered as a one person. Means there is no any separate legal entity. And in a partnership, there is no any separate legal entity. For the corporation, there is a separate legal entity, yes. Corporation is different, right, from the person who is running the business. It means the person who is running the business is separated from its business. Because if the person who is running the business means the started his corporation will give the corporation tax first, then the whatever the income that person is generating from that organization, right, maybe in the form of dividend, will be added and clubbed in his personal income. Then he will also give the tax on his personal income as well. Means personal income tax return as well as corporate income tax return. Corporate income tax return for the corporation and personal income tax return for the whatever that he has earned personally. So this is a separate legal entity. A limited liability, if we talk about the limited liability, proprietorship and partnership, they don't have any limited liability. It means it's not limited. It means unlimited liability in case of the proprietorship and partnership, but not in case of corporation. So corporation have a limited liability. It means the shareholders are the owner of the organization and will be held responsible only up to the number of shares they have bought. If, for example, that I have bought some share of the Tesla company, and I will be held responsible for the number of shares that I buy or I have bought, not more than that. If the company get insolvent, then I will be losing that number of, for example, 10 share into 200, then $2,000. That's it, no more than that. So it means that if the shareholders are the owner of the company, and there will be a limited liability towards the holding. Business tax, yes. So there will be a business tax as well, which is known as the corporate tax in case of corporation, but not in case of a proprietorship and partnership. One owner is allowed in case of a proprietor, yes. In case of partnership, at least there should be two. Only then there will be a partnership. But in case of corporation, even one person can start a corporation. There is no any problem. Sometimes there may be a little confusion that for the corporation there should be a big number of people. No, only one person can start the corporation. That is also very much possible. So corporate form of organization, it says that the corporation is a separate legal entity created by law. Owners of corporation are called the shareholders, and share capital or capital stock is a general term referring to the all type of corporation shares. Two types of share issued. Issued means sold by the corporation to its shareholders. The first one is a common share and second one is a preferred share. What is a common share? The common share, when someone refer to a share in a company, they are usually referring to common shares. Those who buy common share will be essentially purchasing shares of ownership in a company. A holder of the common share will receive voting right. That is the common share. But common share, the person who is buying those shares will be considered as a shareholder, and they will be having the voting right. But on the other side, other type of shares are the preferred share. So preferred shares for that there will be some preferences for receiving the dividends and for the distribution of the assets if the corporation is liquidated. Usually does not have right to vote. So preferred share is different from the common share. The preferred shares, those person who is having the preferred shares, they will get the first preferences from the profit in the form of a dividend, right? But the common shareholders, they will not get the preference. There will be a second preference for them. In case of insolvency, if something is going wrong in the organization, then the preferred shareholder will get the first preferences for their payment, for their the amount they have spent in the organization. So corporation can be publicly held corporation or privately held corporation. What is the difference between two? Public held companies can generate fund by issuing the share to the public, right? As it is clear from the name itself. And this company can raise money very quickly by offering shares to the public. But privately held companies or corporations, what does it mean? It is clear from the name itself as well. Private companies can issue stock to the existing shareholder or current employees, but they cannot raise money as quickly as public company, and they cannot issue share to the public. They cannot generate money by issuing the share to the public. So this is known as the privately held corporations. Now, what are the characteristics of the corporation? Then corporation has certain characteristics that are unique to this form of organization. These characteristics are discussed step by step. The first one is capital acquisition. It can be easier for the corporation to acquire debt and equity since it is not constrained by financial resources of a few owners. A corporation can sell share to new investors, and larger entity can issue the bond to obtain the significant amount of debt financing. Buying share in the corporation often is attractive to the investors because of the advantage of the corporation form of organization, because there is a limited liability. So that's why people will be ready to invest money in the corporation, because if they will be investing, they will lose only to the number of holdings in case there is a loss to the company or the company is going to be liquidated. Lifespan, the corporation lifespan, right, can continue indefinitely, means for the long period of time. The reason being, it is not tied to the physical lives of its owner. If one shareholder dies, then it's not going to affect to the corporation. And this means the corporation can exist as long as it continue to be successful. Just like in case of sole proprietorship and partnership, if the partner die or sole proprietors, like if owner die, the business will be closed. But in this case, the corporation is not going to close. It will be just will go for the long period of time. Limited liability, as I have already explained. Because a corporation is a separate legal entity, it is responsible for its own act and own debts. Shareholders are not personally held responsible for the debts of the corporation. That's why it is known as limited liability or limited companies. Ownership. Ownership of the corporation is evidenced by the shares. They are usually easily bought or sold. Means the shares can be bought very easily and sold very easily. The transfer of the share from the one shareholder to the another usually has no effect on the corporation or its operation. Ownership is a corporation. Ownership in a corporation is based upon the number of shares owned. Buying or selling these shares shift the ownership of the corporation to the different investors. A public company that has its share traded on the active stock exchange may have thousands or millions of owners. So it means in the private company there will be very less shareholder, but that will be limited to their existing shareholder and privately. They cannot sell share to the public. But public limited companies, definitely they can sell share, they can issue shares to the large number of public. Even today, if you would like to buy share of like Tesla company or RBC or Scotia Bank, you can buy. anytime that you can open a account like a iTrade account from the Scotia Bank, for example, and you can buy share anytime, you can sell share anytime. It's upon you. So this is like benefit. This is the benefit of public company. They can issue, they can sell share, and they can collect money very quickly, that as and when they require. Professional management. Shareholders are not a corporate agent. First of all, if you are a shareholder, I am a shareholder of some company. I am not the corporate agent or employee of the company. A corporation acts through its agent, who are the officers or the manager of the corporation. If there is a company, it should be managed by some companies, right? Some people. Shareholders cannot manage, but only they have the voting right. But on the other side, that the company, the corporation will be managed by some people. So those people are known as officers or agents of the corporation. Shareholders who are not officer or manager of the corporation do not have the power to bind the corporation to conduct. It means we are the shareholder when we buy some share, for example. And the shareholder are the owner of the company, but we cannot bind the company by making some contact with anyone. We don't have right to bind. But even then we are owner, but we don't have right, right? This can be some limitation, but for the safety of the company, they have made this provision. But who can bind? The officers, they can bind the company. And this is also referred to as a lack of mutual urgency. The government regulation. The corporation must meet requirements of a provincial and federal incorporation law. Single proprietorship and partnership escape some of these regulations, and private corporations, however, are exempt from the most of the security and corporation legislation reporting requirement. It means that the proprietorship and partnership, right? They no need to make some reports for the public. There is no any such a requirement for the public company, and this is the mandatory and the requirement. They have to disclose the financial statement to general public. It's mandatory for them. Many Canadian companies are listed on a US stock exchange as well, and are also required to file their annual reports with the US regulators. Corporate tax. A corporate tax is a tax on the profit of the corporation. The taxes are paid on the company's taxable income. For example, the revenue here is that's this much of amount minus cost of goods sold, general and administrative expenses, selling and marketing expenses, research and development, depreciation, and other operating costs. That all will be deducted, and the rest amount will be the taxable income. And there will be a corporate tax on the profit of the corporation. Corporate tax are collected by the government as a source of income. So the corporate tax, that will be considered as the source of income for the government. Just like the Canada Revenue Agency, they take taxes. That will be considered as the income for the Canada Revenue Agency, CRA. And the profit earned by the corporation may be left within the corporation and allow for the tax planning and potential future tax advantage. What is the meaning of this? It means, for example, that you have started your corporation and you consider that this time the corporation, the profit is $100,000 or maybe $200,000. And you don't want to pay this much of tax this time. What you can do, you can keep that money in the retained earning. You can keep that profit, and you can declare that this profit that we have transferred to the retained earning section, and we will not pay tax this time, and we will pay tax next year. So tax planning can be done in the corporation. This is the real and very good benefit for the owner of the corporations. So corporate tax in BC is the 12%. Now what are the disadvantage of the corporation? The government regulation. In case of corporation, they must meet the requirement of the provincial and federal incorporation law. This is the one thing. Lot of requirements are there for the incorporation or starting of the corporation. Corporate taxation, sometimes that will be considered as the double taxation system. So in this case, what happened? The corporate income tax is a tax that we know, right? And when the income is distributed to the shareholder as a dividend, then it is taxed at the second time as the personal income as well. So this is considered as a double tax. How? For example, I am an owner of the corporation. I have started one man. So one person have started and can start the corporation. Now I have 100,000 profit, and I just gave 12% of that. So 12% of that I will be just giving as a tax. So $12,000. Now from the $1,000 profit, right? So if that profit that I am just going to distribute as a dividend to myself, right? So again in my income that amount will be added. Again I will pay tax. So this is the limitation of the corporation in this case. So there may be number of provisions to save this one, right? But separation of the management and ownership. So ownership and management, that is the separate, because the shareholder are the owner of the company and they cannot manage. In spite they are owner, they are considered as the owner. So the management, they manage everything. So this can be the disadvantage of the corporation. Now organizing a corporation, it means how to set up the organization or corporation. It means the one word that we use for this, that is incorporation. A corporation may be created either under the provincial or the federal law. Those incorporated federally must comply the Canadian Business Corporation Act (CBCA), the legal document known as charter, an article of incorporation, or sometimes we can say the memorandum of association, which is signed by the prospective shareholders. So now if we talk about the cost, startup cost, the cost of the organizing a corporation are the organizational or organization cost or startup cost, which include legal fees, promoter fees, and amounts paid to obtain a charter. Charter means the written grant to start the corporation. So there may be some fees for that. So that will be considered as a startup cost. Management of the corporation, at the end that we see that there are the shareholder, they have authority over the board of directors, right? So shareholder have the more power. Shareholder have a voting right. On the basis of the voting right, they vote and they select the board of directors. So once the board of director is there, so board of director have authority over the CEO, chief executive officer, and other executive officers as well. So it means board of director have more authority than CEO, and the shareholder have more authority over the board of directors. And now the CEO and other officer have authority over the employees of the corporation. So in this way, this is the hierarchy system. The top level is, we can say, the shareholder, then the board of director, then the CEO and the other officer, and at the end there will be the employees of the corporation. Shareholder have unlimited control through the power to vote and elect the board of directors. Shareholders are the main power, have main power to elect the board of directors in the company. And board of directors has a final managing authority, but it usually limits its action to selecting the board policy. Whatever it is there in the board policy, accordingly they have to do. The board policy is generated by in collaboration and talking with the shareholders. Executive officer, that is appointed by the board of directors and manage a day-to-day operations and directions of the corporation. Now we can say, what is the CEO, Chief Executive Officer? CEO is elected by the board and the shareholders, and CEO is the highest ranking executive in the company. Broadly speaking, a Chief Executive Officer, the primary responsibility include making major corporate decisions, managing the overall operations and resources of the company, and acting as main point of communication between the board of directors and corporate operations. So board of directors are there and the corporate operations. So CEO is just going to manage between these. Now Chief Financial Officer, this is the second, the big officer is there. Chief Financial Officer focus specifically on the financial matters, and Chief Financial Officer, CFO, analyze the corporates or company's financial strength and make a recommendation to improve the financial weaknesses. CFO also track cash flow and oversee the company's financial planning, such as investment and the capital structure. COO, that is the Chief Operating Officer, the third one. COO is ranked second highest after the CEO. As the head of the human resources, their responsibilities fall on the recruitment, legal, payroll, and training along with the administrative duties. Now, what are the rights of the shareholders? According to the Canadian Business Corporation Act, the shareholder have three basic rights. The first is the right to vote, then the right to receive a declared dividend, and the right to receive the property of the corporation after its closure. So what we have learned from this lecture? We have learned the different form of organization, characteristics and a disadvantage of the corporation, organization and incorporations. Then organization cost, it means startup cost, management of the corporation, board of directors, CEO, CFO and CEO, and rights of the shareholders as well.